tell everybody what a TFSA is and what are the benefits for it.
Okay. So the Government of Canada said in 2009, any Canadian 18 or over can put $5,000 into an account. Any growth you make on that, you don't pay tax. And when you take it out, you don't pay tax. And then there's been new contribution amounts every year. There was one year, I think it was 2015 or 16, it was 10,000. For this year, it's 7,000 of room. So if you were 18 in 2009. So if you didn't have a tax-free savings account that was fully maxed out, let's say you've never opened one before.
Right.
So we're recording this in 2025. You would have 102,000 of room. If your wife had never had a tax-free savings, she would have 102,000 of room.
Got it.
So my philosophy is the sooner you can fill that up, the better if you have the surplus cash flow, because that money is growing and accumulating tax-free. Within that account, you could be very conservative. You can put it in, I find a lot of times banks will put people in what's called the daily interest savings account.
Okay.
So it might pay you 1%, maybe 2%. You can put money into a GIC. You can put it into mutual funds. You can own individual stocks. So it's open as to how you invest the money. The one catch, though, with a tax-free savings, I always say to people, not to be a negative Nelly, but whenever the government gives something, there's usually a catch. So the catch with the tax-free savings is if you over-contribute. So let's say, you've maxed out, you put the 102,000 in there, and, you didn't realize you had maxed it out, and you put another $10,000 in. Had this happen with the client, I manage how much she puts in there because I'm an authorized tax preparer at the CRA. I can see what the room is, but I have the one client who went into her credit union and she put $10,000 into what she thought was a traditional savings. It was a tax-free savings. Well, what happens is the government normally will send you what's called an educational letter to give you a warning, hey, you need to take this out. I don't know if the lady didn't get a copy or she missed it, but anyway, she got a letter from the government saying, hey, you've over-contributed by $10,000, and they assess you a 1% penalty per month until you get that over-contribution out.
Wow.
So you do the math, that's $100 a month.
Yeah, that's pretty costly.
So that's one of those things where you have to be really careful. If you have a CRA My account, you can log on. I mean, myself as a financial advisor, I track that for clients. I'm pretty much everybody's authorized tax preparer at the CRA anyway, so we can make sure that we manage that. But if you're watching this and you're not a client, the key is you can go to the CRA My account and see what your contribution room is. However, we are recording this in the middle of April. My personal tax-free savings contribution room has not been updated yet by the government, and a number of other people's have. So it's hit and miss.
Okay.
So the key is when you log into the CRA account, you can click on a button where it says summary of it says your contributions and your withdrawals. So if you made a contribution in 2024, check to see if that shows up there, because if it doesn't, then, and let's say you added the 7,000 that you were allowed to last year, you might go on and it might say, hey, you have 14,000 of room. Well, you don't, because they didn't account for the 7,000 you did last year, plus your 7 for this year. So again, when the government gives something, but I've seen some of these nasty letters that people get where they ignore them. And over time, if you leave that extra money in there, it just accumulates over and over and over again. I have a young man that I met with a few weeks ago. He unknowingly put over $200,000 into a tax-free savings. He did not have that room because he's late 20s, so he doesn't even have the 102,000 of contribution room that someone like you and I I'm in my 40s, you're past your 40s now, aren't you? But anyway, so the key is, I got having a discussion with him. I said, okay, so let's log into the government website, and we looked, and I said, you realize you didn't actually put money into a regular bank account. You put it into a tax-free savings. We need to get this out and do some damage control. So TFSAs can be a magnificent tool, a great way to grow and accumulate money. However, the catch is you got to be so careful about how much you contribute.
So put it in there, but just don't go over your cap.
Right.
Because then,
Yeah, and then an RSP. So when you put money into an RSP, you reduce your taxable income. So let's say, for example, you make $80,000 a year. And, you go to a job where your employer's taking off tax based on you making that $80,000. And then you say, okay, I'm going to put $10,000 into an RSP. You're essentially reducing your taxable income to $70,000, and you're saying, okay, I've overpaid tax. So that $10,000, so at $80,000, you're in a 29.65% tax bracket. You put $10,000 in, it depends on what your other deductions are, but you should get about $2,965 back by putting that $10,000 in. What happens? You put that $10,000 into an RSP, it's going to grow and accumulate. You get taxed on that money based on your marginal tax rate. So most people think they're going to be in a lower tax bracket when they retire. And if so, then you pay tax on that later on down the line. But that's not always necessarily the case. So tax-free savings. So the difference is tax-free savings, there's no tax when you take the money out, and there's you don't pay tax on the growth, but there's no tax deduction. So you put money in, nothing happens on your income tax return.
Got it.
With an RSP, you get taxed on the money when it comes out. So it's going to grow tax-free. It's going to grow within the account, but when you take it out, you have to pay tax and you get an income tax deduction. So the key is just knowing the distinction. I mean, tax-free savings accounts have been around since 2009, so we're 16 years of having these. But there are a number of Canadians that still really haven't grasped the difference. That's why we do so much education, and financial literacy is just, there's a lot of information to know when it comes to finances and financial planning. So that's why we do these type of podcasts, so that people know the differences between a tax-free savings and an RSP.
Nice. All right, so give some real life examples of when a TSFA would be more appropriate.
Okay. So if you're just trying to build up just general savings, so maybe you're trying to save for a car, or you're trying to save for a vacation, then you would want to put money into a tax-free savings because it's shorter term, right?
And I can take that money out and not be dinged with it.
Exactly, yes. And then an RSP might be if you're saving another pot of money for retirement. So it's like, okay, I'm going to leave this money. I have an emergency savings. I know I'm not going to touch it until retirement. Then an RSP may make more sense. So everyone's situation is applicable. That's just a very generalized way of looking at it.
So the way that I got it organized in my head is that TSFA, I can put a lump sum of money in there and be able to grab it in case I need it, in case of an emergency, or if I want to buy a new car, right? And RRSPs is something that you want to put money in and not touch until you retire.
Yes. And TFSAs, you don't necessarily have to put a lump sum. You could just, you could start with putting, $50 a week or $100 a month. The key is just to get that savings going.
Okay. Nice. When's a real life example of when an RRSP would be more appropriate?
Had situations lately where people are getting buyouts. So we live in Windsor, the automotive capital of Canada. So a number of companies are offering buyouts for people to leave early. So if you take that money, for example, Ford Motor Company is offering some people $50,000 buyouts. If you take that $50,000 and you roll it into an RSP, then you don't have to pay tax on that money until you take it out. So you can imagine, I've had people that I've been meeting with that are making $100,000 to $150,000 a year. If they took the buyout as cash, then you have to add $50,000 onto your taxable income. Whereas if you roll it into an RSP and then you wait until next year when you're retired, then you'd be in a lower tax bracket.
It wouldn't hit you as hard.
Exactly. So that might be a case if you have a year where, maybe you've gotten a substantial bonus. Sometimes people roll that bonus into an RSP so that they don't have as big a tax hit. Mm-hmm. There's a number of different circumstances where an RSP would make sense.
Okay. That's really good. Tell us the story about the young man working at the liquor store.
Okay. Yeah, so I had a gentleman come in, it was about a year or so ago, but it just, we're going to share a couple stories today where it just really sticks out, where, a young man came in and said, I want to open an RSP. I said, okay, what do you do for work? Why work at the liquor store? Okay, how many hours a week? 15 to 20. And he's going to school. Okay, so what's your total income? We figured he'd make about $20,000. So I said, okay, you are based on the basic amount, this young man's not going to pay tax on the first $15,000 to $16,000 of income. Then he's only going to actually pay tax on the next $4,000 at 20%. So I said, okay, well, you're going to pay tax. You're going to pay 20.05% tax on $4,000 of income. I don't know that an RSP is the best bet. Well, my dad said I need to open an RSP. I said, okay, that's cool, but time out. Let me just educate you on the difference between an RSP versus a tax-free savings. So I said, okay, let's say we decide that, you've got some money, you're living at home, you have $5,000 that you don't really need, and this is what you want to start with. So you're going to put the $5,000 in. So if you're only going to make $20,000 this year, then you actually are not going to get any income tax benefit by putting the money into an RSP. So it was last year he came in. So the basic limit was $15,705 in 2024. So on the first $15,705 you make, I make, any Canadian makes, there's no tax. Well, then if you put the money into an RSP, so that he's made $20,000, then he has a $5,000 deduction. It's a wash. There's no tax, no nothing. So I said to him, I said, what do you want to do when you're finished school? And he said, well, I'm going to school for police foundations. I want to be a police officer. And I said, okay, do you know how much police officers make? You have an idea. So do you have an idea what a police officer's pension is? Kind of, sort of, maybe like $60,000. I said, well, try higher. If you work 30 years as a police officer, I have a number of clients that work for the city of Windsor, a lot of police officers, some are retired. Said I have a few clients that are retired police officers that their pensions are close to $90,000 for the year. Do you have any idea what the marginal tax rate is then? No. I said, well, you're at the at 80,000, you're at the top of the 29.65% tax bracket. But let's say you finish school, you get a job, and then you retire as a police officer at age 60. Maybe decide you want to start taking Canada pension. So you have your OMERS pension that the city of Windsor is paying you for being a police officer that's retired. Then we add on your Canada pension. Then we're going to add this RSP income on top. You're going to be at the very, very lowest tax bracket, 33%.
Okay.
But if you save and you go down this route of putting a lot of money into RSPs over time.
Or if you get an inheritance.
Yeah, then you could potentially be in a higher tax bracket. So here you are, 22 years old, going to college, and going to get zero income tax benefit by putting this money into an RSP. Then we're going to kick the can down the line 30, 35 years till you're retired, and then you're going to pay 35% tax. But you just put this $5,000 in. Over time, this money's going to grow and accumulate. So that $5,000 that you put in could potentially grow to, could be worth $20,000 or $30,000 by the time you retire. So let's just use $30,000 as an example. That $30,000 when you're 60 years old, taxed at 33%, you're going to pay $9,000 in tax, almost 10. Do you think that your 22-year-old self remembered that you got zero income tax benefit? So I understand that your dad just wants you to save, but I want you to understand why an RSP in your situation is not a good choice. Hey, when you're working full-time as a police officer and you've worked for a few years and your income's $100,000, that is a totally different story. But while you're going to school part-time, putting money into an RSP is a horrible idea because you don't get any income tax benefit. This is why we're going to put your money into a tax-free savings, and here's how we're going to get you to save. Right? So that's the one. And I think the next question on there is about the bricklayer.
The bricklayer.
Similar situation. 18-year-old kid comes in, finished school. He did the Ontario Youth Apprenticeship Program, and so he got a job right out of school. My mom says I need to put money into an RSP. Okay, well, what's your income like? So, we had to figure out how much money this young man was making per hour, and it was like $22 an hour. I said, well, if you're a really good bricklayer, down the line, say 10 years from now, when you've got all your hours in and all that sort of stuff, what are you making? He's like, oh, there's bricklayers that make at least $100,000 a year. Okay, so at $22 an hour, you're going to, and when you're in a bricklayers union, then you pay into a pension plan.
Okay.
So if you're making $22 an hour now, and you're working 40 hours a week, maybe more, you're going to make, probably $40,000 to $50,000. You're probably in a 24% tax bracket. Fast forward to when you're retired. Again, same conversation as the liquor store young man, where if this kid thinks he's going to be making $100,000 a year later on, then I said, RSPs are not a horrible idea, but they're not the best idea right now. Later on, when you're older, putting money into an RSP may make sense depending on what your pension plan is going to look like.
Right.
So I applaud these parents for telling these kids, they're still, they're adults, but they're still kids. I applaud the parents for saying, hey, you need to save. But the key is really understanding how the accounts work. And so for younger people, so in this gentleman, the 18-year-old's case as well too, I said, okay, we're going to open you a tax-free savings account, and we're going to have you start saving in the tax-free savings. It doesn't make sense for you to put money into RSPs.
It almost sounds like when you're at the beginning of your career, the TSFA is kind of the better bet.
Generally, yes. Everyone's situation is different, but until you're really making a really good income, then we want to look at, and then, the key is though, this 18-year-old, and what are you saving for? Well, I want to buy a truck. Okay, well, then we can't put money into an RSP and have you take it out because you're going to have to pay tax on it. So, I get what your mom said, why you should save. but let's have you save in a TFSA, and this is why.
Because it's liquid and you can draw the money out and not be dinged for taxes.
Yes. Again, that's why it comes back to education, right? So I wrote a book in, as you know, in 2017 called Why You Need a Financial Advisor. We list out examples, and real life examples. We've changed clients' names of when they should put money into a TFSA, when they should put money into an RSP. So these are typical conversations that I have with people every day. So in some cases, it makes sense for people if they have enough cash flow to have a tax-free savings and an RSP. Everyone's situation is unique. So again, I applaud these young people that mom and dad are saying, hey, go talk to somebody, go save some money, but we just want to make sure that we're having them save in the appropriate places.
Okay, so we're touching upon people just entering the workforce at the beginning of their careers, and their parents are doing the right things by telling them, you should be saving money, you should be looking at ways to invest and grow your money and have it work for you, correct? But let's touch upon the thing that nobody ever tells you about is that at some point you have to start taking that money out.
Yes. Yes, you do.
And that's on the opposite end of the spectrum when you start winding down and getting closer to retirement. So can you touch a little bit upon that? Because I think that is the one thing that I've learned the most that was kind of shocking to me when I first started working with you is that nobody ever tells you that at some point you got to start taking that money out.
Yeah.
Like they all tell you, RSPs, investments, save your money. But if you're not careful, could end up costing you in the long run.
Yes. You know what? It's funny. I thought of this lady the other day, actually, who I met with. She saved in a group plan. So she worked for a company in Toronto for years, ended up right-sizing, downsizing, whatever you want to call it. She moved down to the Windsor area. And I said, okay, we need you to start getting some of this money out. This lady is married. Husband's a little bit older. So chances are he's probably going to go before her. And I said, okay, but you don't have any children. So what happens if you don't get this money out? This woman did not realize, and she worked for this company for 30 years, putting money into a plan. She had no idea how this money, she knew she was going to pay tax on it when it came out, but she didn't know what would happen if she didn't get all of it out by the time that she's died. And so I explained, if you don't get this money out, that money goes on your final tax return and your estate is paying tax on that money.
Right.
So the key is
that's where the big tax bills come in. That are like, whoa.
Yeah, and the key is having a plan to get the money out. So I'm a big advocate for decumulating money sooner rather than later. So yes, you have until age 71 to turn your RSP into a RIF so let's say you have $100,000 in an RSP, and the year that you turn 71, you have to turn into a RIF, a registered retirement income fund. So the government says, okay, we've let you tax defer this money for so long. Now you have to take out 5.28%. So you have to take out $5,280 per year. But what if your investments are making greater than the 5.28%? What if your investments have been making 7 or 8%? Then you're not even eroding your principal that's in there, right? You're just taking the growth. And that's where these tax issues happen over time. And, if you have a situation where you have a husband and wife, typically men will pass away first. So husband dies, all of the registered money rolls over tax-free to the wife. Then you got the wife. Well, she's probably got some Canada pension. Yeah, she's got some old age security. Yes. Maybe she's got some of his survivor's pension. Maybe she has some of her own. And then you have all of this registered money.
And then all of a sudden you're not in this tax bracket anymore.
Yes.
You're in this tax bracket.
Right. So the key is having a plan, right? A lot of times, and we've had discussions about this before, where only 14% of Canadians retire with an actual written plan. We lay out a tax plan. Here's what your income is going to look like. Even if you don't need the money to run your household, we want to get it out. We want you to pay the tax man and then shift that money to a tax-free savings. Shift that money maybe to a non-registered account. Maybe you're paying down debt. Maybe if you have enough money, maybe you have the ability to take your kids on a vacation or help your children so you can watch them enjoy the money, not once you've passed away one day. So the key is having a clear, articulated strategic plan to start taking the money out. Because we're recording this, we're a week away from our federal election. We have no idea who's going to be running our country soon, but I'm pretty sure the one thing we can agree on is that our tax rates are not going to go down anytime soon, right?
Yeah. Death and a tax man. Those are the two certainties in life.
Yeah, and as much as some people promise that our taxes are going to go down, personally, I'm not buying it.
Right.
Taxes are supposed to be a temporary measure during the World War. I think they're around to stay.
They're making too much money to eliminate taxes.
Right.
Yeah.
So, but the key is what you can control is what you spend and what you save, and then also how you plan effectively to make sure that you don't unnecessarily pay too much tax.
It's a lot.
It is a lot. But the key is if you find somebody, retire. And so we talked earlier about, two young men that had come in to see me.
Right.
Their parents are acquaintances of mine. I typically don't work with younger people, right? We have Olivia in our office that works with younger people. But, the gentleman I gave the example of the bricklayer, I've known his mom for years, and she trusts me and, told him, and she's a client, come and see me, which... she should know better. He should be putting money in a TFSA, not an RRSP, but at least mom kicked him in the butt and said, go see a lit. Okay. So I met with him. Money. But my specialty, my jam, my favorite thing to do is retirement planning and the tax planning and laying it out for people. So if you're watching this and you have a financial advisor and you don't have a clear articulated plan as to how the money's coming out, ask them, how am I going to take this money out? You're just going to leave this... You leave your money in an RSP just grow and accumulate, you're just growing this tax liability for your estate. Don't do that. Find somebody, work with somebody that's going to give you a plan and a strategy so that you don't unnecessarily pay too much tax. I think that's really what sets us apart from other people, is that everyone has a retirement plan that comes in to see me, and they have a tax plan laying out, this is what your income's going to look like in retirement.
Right. I think that's such an important aspect people don't realize, is the whole tax planning for when the estate, when people die, my gosh, and then you tell them that they owe hundreds of thousands of dollars to the government. It's not a easy conversation.
Yeah, once your income's over $220,000, you're in the highest tax bracket, right? And I've said this in previous podcasts and YouTube videos. The later in the year somebody dies, the worse it is. And it sounds horrible to say, but you've got, CPP, OAS probably... Maybe you've got some pension income, and then if you haven't cashed out your RSP, LIF, RIF, LIRA, whatever acronym you got going on in terms of registered funds,
that all builds
gets tacked on your final tax return if you don't have a spouse to roll it over to. And then you are paying, what's the highest tax bracket?
53%?
53.53%. So the government is getting more money than your family.
Wow.
And sometimes it's just book a quick conversation, right? And just really the awareness. Yes, obviously the government needs to raise more tax revenue to pay for, roads and schools and police officers, etc. But it doesn't have to be at the expense of the CRA being the biggest beneficiary of your accounts. Because if you don't plan properly, they are going to be the biggest beneficiary. It's not your kids, which is extremely unfortunate. So just with a little bit of planning, you can avoid that.
So this is the takeaway from today's podcast, is that if you work 30 or 40 years, you don't want the government to be the biggest beneficiary of all that hard work.
Right.
If you'd like your family, your friends, or your estate to be the beneficiary, talk to somebody in the know about your tax planning and your retirement plan, because it's so, so, so important. And at 53%, where you get bumped into that highest tax bracket, man, your kids could be staring down a huge tax liability bill. Absolutely. Which is can be devastating, and I'm sure you have stories to relate to that as well.
That's a whole other podcast right there. Yeah. The do's and don'ts. Yeah.
All right. So anything you want to leave us with TFSAs versus RRSPs?
I think the key is just do general savings. So if you're not sure, start with a tax-free savings. Just get money, out of your bank account. Just get in the habit of actually saving and put it into a tax-free savings to start if you haven't opened one yet, and get that money growing and accumulating, and then figure out, okay, how much do I put into an RSP, or does an RSP even make sense? I think the key is just that momentum. It's like, if you keep saying, oh, I want to get healthier, what's the hardest thing? Putting on your running shoes and getting out the door to go for that walk or go for the run or go to the gym. Same with finances. It's like, just do something to take action. Open, if you're not ready to talk to a financial advisor yet, that's okay. I don't think we're scary people. I'm really warm and open and welcoming. I think I'm really easy to talk to. Might be biased, but you know what? When you're on your online banking, open a tax-free savings and just get in the habit of putting $50 a week or $100 a month. Just get the ball rolling, do something. Then when you're ready, sometimes people feel like they have to pay off all their debt or have this big chunk of money to talk to a financial advisor. No, just be willing and wanting to make some positive change, and then seek somebody like me out to say, okay, where's the best place for me to save? So if you've taken the time to watch this podcast, do yourself a favor, take some sort of action in the next 24 to 48 hours. So have a conversation with yourself. Is who I'm working with right now, they might have gotten you from point A to point B, right, to get you to save. When you get to the top of the mountain and you're ready to start decumulating and enjoy your retirement, is that still the same advisor that's going to help you get down the mountain?
Is that the right person, right?
So, we take over a lot of accounts for people that they've worked with the same people for years at the bank, but they just don't have the tools in their tool belt to help them with the decumulation strategies. And that's okay. They've gotten you to where you're at. Sometimes you need to make those changes.
Right.
So I think the key is just do something to take action. Or if you haven't done any savings yet, just open a simple tax-free savings account through your bank, through online banking. You don't even have to go talk to anybody. Just get in the habit of actually putting money away.
All right. So those are your takeaways for today's podcast. I hope you've been paying attention, and we will see you the next time. Have a great day.